My name is Guy Kaufman. I'm the startups lead at Vested, and I'm going to be very much taking a backseat today and serving as your presenter, your, I don't know, not very glamorous assistant, and asking the questions that you've submitted in advance to our fantastic panel. Before that, just a little bit of admin. We will be recording the session. So if you want to go back and look at anything, it will be available on our YouTube channel. Also, there is a chat function, which is probably completely beyond me, but if you have questions as we go, please do write them in. Like I say, we've had an amazing response to today's session. We've been literally inundated with questions from you guys. So I've done my best, I guess, to comb through those in advance and aggregate them so we can squeeze the most value we possibly can out of our fantastic panel. But if other things occur to you, please do write them. And if you don't get your question answered, feel free to reach out to us, or certainly reach out to me directly or any of the team at Vested, and we'll be more than happy to answer those questions and hopefully help you on your fundraising journey. I think that segues me quite nicely into an introduction of the panel today. That was done better than I expected, or we'll see. But first up, we have Dharma Sathya Nathan. I hope I haven't mispronounced your surname. I did give it a couple of practices, so apologies if I have. Dharma is a partner at Bethnal Green Ventures, Europe's leading early-stage tech for good VC, backing ambitious founders using tech to tackle pressing social and environmental issues at scale. At BGV, she leads on deal flow, community, and networks, driving BGV's effort to act with integrity on diversity, equity, and inclusion. Dharma previously worked for international NGOs advocating for better human rights practices in global development and humanitarian response, has a background in international relations and human rights. Xavier Bellicer is next up. Sorry, Dharma, thanks for the wave. I'm just continuing now, beg your pardon. Xavier is a director at the Angel Investment Network, a platform connecting startups with angel networks all over the world, across 90 different countries, in fact. I've worked with AIN on a number of projects and introduced them to a number of founders. So I can attest firsthand that it's an amazing resource, an amazing platform for founders looking to raise. Xavier heads up the broking division, where in just over 10 years, he's helped startups raise around £200 million. They're always on the lookout for dynamic teams with great ideas for what they do. Finally, last but not least, Ifti, my boss, founder and CEO of Vested, the UK's leading share scheme and equity management platform. Ifti's spent, the last 10 years again, helping startups. He's a font of knowledge for all things equity, really. So share schemes, investment raising, anything you can think of. And he's an all-round good bloke. So there you go. Those are our three panelists. I know you've all got lots of questions. Like I say, we've tried to aggregate them as best we can, and I'm going to be putting them to the panel in no particular order other than how you appear on my screen, to be honest. So first up, we have a question about shifts in the fundraising landscape. So I think anyone who's worked with startups over the last 10 years, as that seems to be the number that keeps coming up, will have noticed a big shift here, a big change in the fundraising landscape. What trends do you see now versus, I don't know, say 2021 when money was a bit cheaper, or even pre-pandemic in terms of that landscape? Dharma, you're first on my screen, so if it's okay, I'll pick on you first.
Yeah, sure. And thanks so much for having me as well. It's a pleasure always joining these things and actually talk a bit more about what sort of trends we also see in the funding landscape. But I mean, suffice to say that fundraising, if for anyone, whether it's GP, LPs, and especially founders, is incredibly tough at the moment, considering sort of where the market has gone and the sort of experiences of actually coming out of a global pandemic, a lot of transformations that needed to happen in the space as well. So it feels like it's been just a long stretch of really hard times, and at least hoping that there's a bit of a market correction when it comes to the sort of inflated valuations that we might have seen over the past years. But what's become more evident as well is that there's definitely been, at least what we sort of see in the VC landscape, that there's been a bit of a change towards how people are sourcing deals now, and actually putting a lot more emphasis on being a bit more data driven, actually seeing a lot more earlier signals of what sort of feasibility some of the tech products and services that people are building have in the market before they actually make a commitment as well. So, which basically translates into there's a lot more due diligence that happens from the VC side now, regardless of the stage. So even at pre-seed, and we had loads of our founders, for example, say that a lot of the expectations have shifted for pre-seed deals as well, where they kind of operate on a basis that they are looking at deals at pre-seed, but are expecting seed metrics to have achieved, to have been established already, which makes the fundraising journey a lot harder for a lot of founders as well. Which is possibly also one of the reasons why there's been, on the founder landscape at least, there's been a shift towards more non-dilutive capital. So looking at how you can stretch out the sort of pathway to actually get pre-seed money from a VC or from different angel networks and investors as well, to actually be able to validate your product and your service a lot earlier without necessarily getting to the sort of product market fit stage yet, but at least having a lot more validation to de-risking the investment essentially. Um, that basically means it's quite tough fundraising. That's definitely in terms of the sort of shifts that we've seen in terms of how people are going out to fundraise at least. In terms of other sort of trends, and I'll stop there. There's definitely, I mean, we'd be remiss not to mention AI, but there's definitely been a large shift towards generative AI. If we look at sort of the investment volume just in the last years, from the UK and US alone, it's just exploded. Um, and obviously, climate tech is definitely a hot topic. People love looking at climate tech, but then always focus on sort of software as well, which is a bit of a struggle when you actually think about some of the climate mitigation strategies and carbon capture that require hardware. Um, and the massive shift towards software in the space is a bit disheartening. But yeah, those are the sort of two industries and verticals where we've seen definitely sort of more emphasis also from non-traditional investors who are usually not interested in sort of the impact or the positive outcomes, but definitely have a lot more interest in sort of seeing what sort of innovative technologies can be built in the space as well.
Amazing. Thanks so much. Out of interest, so does the increased focus on DD mean that those deals that you are seeing are taking longer to go through, or how does that affect it?
Yeah, I'd say um, because there's that shift towards data-driven VC as such, there's definitely a bit more pattern recognition of actually seeing early signals of like who is a repeat founder who has built a business before. And if you have done that, it's much easier for you to be able to raise a round quickly because you've built your track record in showing that you know or you might know how to build a business, which then basically means that for a first time founder, the playing field is not even, and it takes a lot more grit and a lot longer to actually get to that stage where there's enough sort of confidence from the investors to be able to put in to say yes to those investments. But that's sort of definitely more anecdotal. That's definitely sort of anecdotal from founders that we've seen in the space, from investors that we speak to about co-investments as well. And yeah, just a lot of hype in the space as well when it comes to specific verticals as well. But yeah, it is hard, but it's doable.
Well, that's reassuring. Xavier, I guess you bring a slightly different perspective working so extensively with angel networks in particular. Have you seen the same sorts of trends that
Yeah,
Thomas talked about?
absolutely. As Dama says, it's rough out there, and we see across the board because we're pretty agnostic when it comes to industries. So yeah, it's more about this founder market fit, which is really key. So as Dama says, first time founders are finding it a lot harder. I guess as we're going on through this, kind of trying to come up with solutions that is maybe trying to tie yourself to advisors or NEDs, or surrounding yourself with people who may have had that kind of experience is going to be key for early founders. But yeah, since I mean, even during lockdown, there were some industries that were thriving because of the situation, ed tech and such. They we were having not too much trouble finding money for those, but now it's pretty much across the board, apart from generative AI. As Dharma was saying, there's a couple of industries, but other than that, it is rough. And so yeah, those are the trends. You're asking for trends. Those are them. It's yeah, a rough time at the moment.
Thanks very much, Xavier. And Ifti, last but not least, I guess it's the same question. Anything to add to Xavier and Dharma's point so far?
I think both Dharma and Xavier have covered it very well. I think the point that comes across to me is that just about every investor, whether it's angels through to VCs and PEs, they're very much more circumspect, very much more discerning, because there are a lot of opportunities on the table. So you really do have to shine out to get beyond the noise. But yeah, I think it's been well covered. So I won't just
Yeah, some kind of market traction, as Dharma said as well, that just getting that little bit more traction to give more comfort to investors is key. Obviously, it's a bit of a chicken and egg situation in that you need some money sometimes to get market traction, but more hustle required, basically.
Yeah.
And needing to bootstrap, for being willing and able to bootstrap for longer, or very, very early stage angels.
Well, Ifti, perhaps I can start with you for my next question then, because I think we'll try and change it up a bit as we go and give everybody an opportunity. What sort of criteria are investors looking for when they're evaluating a business? And then the secondary to that, or the second part of it is, well, I know because I work with you, that not only do you run Vested, but you've invested into startups yourself as an angel investor. How do you evaluate the success of those investments?
Okay, well, we'll come on to the success of the investments second. But the first thing is around looking at opportunities in which to invest. And we had this old approach, even at Vested in the early days, which was around the dream, the scheme, and the team. So the dream is the problem that's being addressed or solved here a real problem? Is that dream worth chasing? The second is then the scheme. Is the way in which the problem is being addressed and sorted, is the solution, is the scheme, does it make sense? Does it have legs? Okay. Then the third is the team. Is this team relevant or experienced to address this problem? So before you even get past go, if the dream, the scheme, and the team, if you don't have a tick alongside each of those, you're probably going to be failing, because even if it's a brilliant idea and the way in which you're going to solve it is fantastic, if the team have no relevance or experience in addressing it, it's going to have real problems getting past go, because ideas are a tenner penny, and it's really tough. So minimum is to have that dream scheme and team in place. And then it's around getting that traction. I think Xavier just mentioned it already. You know, having some early adopters or having some experience or people who are willing to buy it if and when it becomes ready. That commitment and traction are key to any idea. And when it comes to looking at the success of a problem, and we're going right to the other end, Guy, and I think it takes a while before you get to that stage in terms of knowing if something's successful. I mean, the obvious one is, you know, do you get more out of it than you put in just from a cash perspective? But that's not the only idea of success. If you move a game forward, a ball forward, an idea forward, and it adds to the broader knowledge of the world, I think that in of itself is also successful, because all investors know that the chances of a startup succeeding is pretty low. We're all honest, we're all true with ourselves. 80 to 90% won't get past go, but those that do will potentially add value to you tangibly or intangibly, and it's that opportunity for that intangible benefit that adds to the world as well that I think all investors are looking for.
Brilliant. Thanks very much, Ifti. Xavier, I'll pass back to you if that's okay. And just to reiterate, we're looking for criteria for evaluating investments and then assessing the success of those investments after the fact.
Yeah, I mean, I'd never heard of the dream, the scheme, and the team, but that does cover it nicely. Obviously, the team, as Ifti said, ideas are 10 a penny. An entrepreneur turns an idea into profit, and that there's a long way to go between idea and profit. So it's about execution. So what I would add to what Ifti says, it's also about how you present yourself as an entrepreneur. If I'm going to hand you over some money, are you going to be the one that's going to turn that money into profit for all of us? So things like, making sure your deck is up to scratch. Because if you've got things that are, just loose and don't look good, then the investors are going to wonder whether they're going to, actually share their money with you. Are you going to be someone that's actually pleasant to be around? The journey, I mean, everybody puts on their deck that the exit's in 3 to 5 years, but it's usually probably 5 to 7 years, and you're going to be tied to that founder for 5 to 7 years. And pardon my French, but you don't want to be tied to an asshole. So you have to also be someone that people want. It's like hiring people for your team. You want to be someone that's going to be part of it. If you're too arrogant, too cocky, those kind of things go a long way, and on top of obviously the foundations, because there's so many things that go into the mix of turning an idea into money that you have to be aware of all of it. Also, I mean,
Interesting.
success of a business, obviously, the tangible benefits. Are you gonna make more money? Obviously, it's a beautiful thing if you can, move the world forward a little bit with it, but a lot of investors still think of their pockets first. And yeah, at the moment, I've made a few investments over the last few years as well, and frankly, staying alive at the moment is pretty impressive, because I've got a lot of my clients and a lot of people that I've invested in as well that are struggling to keep the ship afloat at the moment because it's so difficult to find money.
If I can handle the mute properly. Dharma, I was going to say, as someone who invests very specifically in social impact businesses, I think tech for good was the phrase used in your bio. Do you see things through the same lens that, Ifti and Xavier just described, or is it slightly different?
I think it's fairly similar, because sort of, if we're looking at the sort of stage of investing that I guess all of us are sort of involved in, it's very early. An early stage is a really stupid term, to be honest, because it's such a broad spectrum from literally ideation to Series A, so it's not helpful at all. But presumably we sort of look at pre-product, pre-revenue startups up to sort of seed. And in that sort of space, it's usually down to sort of the conviction in the founders, right? But for us as a tech for good investor, because I'd like to say, despite all the sort of, yes, it is bloody hard being in the space right now, and it's potentially there's a lot of evidence that is the sort of mental toll it takes on people to be entrepreneurs right now is extremely taxing. But it's also very necessary to sort of think about what sort of inspiring, innovative tech products and services we can build to actually make the world a better place. So within our team, we're quite a team of practical optimists, as we like to say. We take a bit of a realistic view of the world and are cynics as well when it comes to it. Me personally, very cynical, as a German as well. But when we assess deals, we sort of look at what could be the impact potential. And as a fund, we have certain expectations as to how much money we want to return into our fund as well. So we'd look at the sort of the scale of the impact potential very early on and sort of try to imagine what that could lead to, regardless of whether the founder has an understanding in the space yet or not. And that's sort of where the tech aspect is quite important as well, right? Because if the infrastructure exists, then the potential for this technology to actually be widely adopted by millions and millions of people is absolutely possible. And we sort of look after, we sort of want to back founders who have that sort of ambition to really dream big and really be excited about the potential to positively impact millions and millions of lives. On the flip side, also, the sort of bigger other assumption that we're making, by sheer virtue of being able to impact so many lives, we also see the sort of returns potential and sort of think about a lockstep model as well, that the greater your impact, the greater your returns as well. And that's sort of validated, thankfully, over the past 12 years of investing in this space as well, that it is actually possible to think about profit and returns together, and that there isn't necessarily a trade-off mentality needed in order to sort of adjust your returns expectations or adjust the sort of potential impact expectations. It is absolutely possible to build venture-backable businesses that are geared towards making a positive impact for people and planet, and also, have great returns for everyone involved in making this business a success, whether that's the founders, whether that's the employees, whether that's the early advisory board that you bring on, the early angels, the early backers, the VC funds. It is absolutely possible to do that. But then that sort of relates to what Ifti and Xavier have said. It is down to how much conviction you have in the founder, and that could be illustrated by the sheer virtue of the sort of subject expertise they bring in the field, by the people they are able to surround themselves with, who actually make the reality of making this business a success. That could be just the sheer possibility of being a visionary in this space as well, because sometimes we do need those visionaries to be able to sort of dream of a better future for all of us. And that's where I feel VC is really well placed to do that, because we do take quite risky bets in making those investment decisions, equally so angels very early on. And that's also one of the reasons why there are so many mechanisms to ensure that we can actually reduce the risk of it not turning out right. But we're fully aware of sort of the possibilities that things might not work out. But then the sort of consequence of that is still that the founders learn from these experiences and can try again. So there's absolutely no harm in closing down your business and trying again, right? And that's the sheer beauty of being able to continuously build as well, which I think is, really afforded in this sort of space.
Thank you so much, Dharma. Interesting to hear all of you put so much emphasis on people and team and people, team and individuals, but the people making this work That's something that I hear, time and time again from investors. Okay, Brill. We're moving through this at the right pace, actually. So well done, everybody. I'm shocked at that. Question number 3, Xavier, I'm going to give this one over to you, if that's okay. So what common mistakes do founders make when seeking investment, and how can they avoid them?
I'm gonna focus on one because I think it's one of the most important, and then maybe others can chime in with us. But I think communication is so key during the rounds, keeping people up to date. I think that entrepreneurs can maybe think they've locked in an investor, and then they go off and they don't keep them. They think, well, that guy's in the bag now. Maybe I've got, a couple of 100,000 committed from a couple of angels. I'm going to leave them. Once you add people to your list of targets or people that you're bringing on board as investors, keep them up to date. It shows, and then it shows that you're on the ball, but it also shows what's going to happen, hopefully, after they invest. A lot of investors come to me lamenting the fact that they don't hear much from the founders, and often as a founder, it's a natural, I mean, it happens to all of us. There's maybe bad news. I mean, as a founder, there's just going to be bad news after bad news. There's always going to be some fire to put out. And I think that entrepreneurs want to paint this really rosy picture, that nothing's going wrong, everything's fine, nothing to see here, your money's all safe, we're moving forward. But I think that you do yourself a disservice and your investors a disservice if you don't keep them up to date. Keep them up to date, obviously, on the good news, keep them happy, but also keep them up to date on what's going wrong, because not only will they appreciate you being transparent, these are people that have hopefully seen some of these problems before and might be able to help. That's having VCs or angels on board that are approachable and can say, well, look, we are starting to have a bit of a cash flow problem here, or we're having a bit of an HR problem here in terms of recruitment, or anything like that. Put it to your investors. I find some of the best entrepreneurs, because I've invested in a few companies myself, is you get maybe a monthly or a bi-monthly update, and then at the bottom they say what they're looking for. As an entrepreneur, you're always in need of something, so put what you need at the bottom, and then you're putting that to your investors who have networks of their own. They've bet on you, so they want the bet to turn out well. So it's in their interest to scour their networks and find the best people or the best advice for you. So that's would be one bee in the bonnet I have about entrepreneurs, is trying to keep quiet, take it on the chin, and take everything on themselves, when actually a problem shared can be a problem halved.
Really interesting. Actually, follow-up question from someone in the audience. I'm trying to manage the Q&As coming in as
Very
well.
impressive, guy.
Well, wait till the end, Xavier. But follow-up question was, what's the sweet spot in terms of investor updates? Weekly, monthly, quarterly? How frequently do you think people should be
I
staying in
would
touch?
say, I mean, you don't have to give them War and Peace once a month, but a little update, I would say monthly, and then maybe quarterly, something in a little bit more depth, because obviously the investors want you working on the company as well, not having to, write out tons of stuff once a month. But I would say a little update once a month with anything you might need right then, because a quarter might be a long time to wait. But then something more in depth once a quarter.
Brilliant. Thanks so much. Ifti, I guess same question. Let's just keep it going. Common mistakes that you see founders making when seeking investment.
I mean, firstly, just building on Xavier's point there and the question, the accounts are something that you can just share. You'll get these off QuickBooks or Xero, whatever. Just share them each month, and then add a note in there if there's any asks specifically. But going back to the piece about being transparent with your investors, I think that is the best advice anybody can give. Firstly, these are the people, these are the ones who have invested in you. So communicating with them, keeping them up to speed is important. And as Xavier said, their networks are key. But for you also, it's the listening side. So yes, you need to transmit where your challenges are, the fact that you understand them and that you're not just hiding away from them, or even ahead of investment. Talk to your investors about the opportunity, but also the challenges that you see and how you may address them, because they know that you know that it's not just a straightforward journey to that profit and success that we were talking about earlier. There are going to be challenges. Have you understood them? Are you aware of them? How might you address them? And how might I, as a prospective investor, help you? The other piece is then showing that you're willing to listen. It's one thing broadcasting your problems. It's another thing being willing to listen and to take on advice. That's one of the big, from all the angels and investors I know, one of the big things is, can they hear that this person is going to listen to them? They may not agree with them, but are they going to listen and take on the counsel, the advice that comes with the cash as well? Because it's not just about the cash. And if they're not going to listen, if you don't show that ability to listen, you'll probably turn off a lot of prospective investors. Because at the end of the day, they want to know that at least what they're contributing to the game, the cash and the experience, is being taken on.
Brilliant. Thanks a lot, FD. Dharma, same question again.
Yeah. I mean, I've got a pet peeve here. Oh la la. What I would say is possibly one of the sort of biggest mistakes that founders are making at the moment is not be very specific in their research as to who they are targeting as well. And that's like the sheer amount of founders, for example, I get who have registered companies in the US, they're raising a Series A round and get in touch with us with sort of the same sort of nondescript email of, yes, we're building this business, we're great to chat. And for us to have to spend and waste our time getting back to them to say, we only invest pre-seed in UK registered entities, sorry, but not sorry, please do your research, is insane. And that's not just an individual case to us. That happens across all VCs that I know of. The sheer amount of cold inbound that is not targeted and is just a waste of time is horrendous. Which on the flip side, if you are really targeted, if you have invested a bit of time to actually trying to find out, and this is purely for VC because the motivations for angels are very, very different, but for VCs at least, having dug a bit deeper as to what sort of investment thesis they have, what sort of stages they invest in, what sort of fund mechanics are behind the funds they are actively deploying right now, because you could easily try to figure out what's the sort of best possible ticket size for XYZ fund based on how much money they're deploying over the next couple of years. That already shows the investor that you've put time and care in actually understanding who those VCs are and how they might actually think about deploying. And actually also gives us a bit more insight as to, okay, they really care about who they want to reach out to and are not just spraying and praying really by emailing absolutely everyone on a particular spreadsheet that lurks about in the internet. The other thing I would say is there's definitely also benefit to sort of, I hate saying this because I'm very anti this approach, but there's a lot of opportunities through cold inbound, but there's an even better chance if you have a warm introduction. That's sadly the reality of this industry. There are specific funds who only operate on warm introductions. They will never get in touch with anyone who just comes to their website or their LinkedIn profiles. But the best currency is really the founders instead of the investors or the potential co-investors. If you get an introduction to an existing portfolio company, to a founder who already has worked with that VC as well, that is 100% trust in the ability to understand who they're really interested in working with. And at least the founders in our portfolio, for example, we've got founders who we invested in 8-10 years ago who are so amazing in just paying it forward and wanting to make meaningful introductions to potential investors, to potential customers across different industries as well, is absolutely astonishing. So actually connecting sort of with other founders in the space, being able to sort of piggyback on their sort of piggyback on their sort of networks as well, and being able to be introduced to different firms that way is actually really, really helpful and meaningful as well. Not to say that I absolutely hate warm introductions. Like B2B, for example, does not operate on we operate on a no warm intro needed basis and do all of our founder introductions through cold inbound. So you can easily get in touch with us through a form on our website. But we will only invite you to a sort of what we call a drop-in session, for example, where we talk about your business for about 20 minutes to sort of see if it's a fit with B2B or not. Only if you fit our mandate. So really digging deeper, researching, does this VC firm fit with what they're investing in? Have they invested in a similar space? But if you're also aware that they have invested in your direct competitor as well, then the likelihood of them investing in you is quite low. So you can already self-select through a lot more research into who you might want to reach out to as well. Yeah, that's one thing I wish founders would do more of. And there's some really great databases where you can dig deeper and find out more about sort of the investment thesis, the approaches as to how VCs would like to be contacted, or even the sort of stages of investment and ticket sizes. And one of the best ones is actually OpenVC, which is a really great database. Highly recommend checking it out.
Thanks so much, Tom. And that's answered quite a few of our Q&A questions, which is super helpful about how people can find the right types of investors. I know Xavier's platform is one way to do that with angels, but yeah, do your research. I think it's clear from everyone speaking today that you need to take a really tailored approach, that it's a really competitive landscape at the moment. And if you're going to go out and ask for money, you better be asking from the right person. So super helpful. One of the other questions in the question and answer section is about valuations, which conveniently is one of the questions I've got in my list. Ifti, I know that this is something that you and I have spoken about quite a lot in the past, actually, different types of valuations and where they're relevant. So I'll start with you if that's okay.
That's cool. Thanks.
What are the critical factors in determining a startup's valuation? Especially given the current market, what's your view on it?
I guess the starting point has to be what we were talking about earlier. Evaluation comes from an investor being able to see that the dream, the scheme, and the team have all been ticked. Okay, so given that that's good, then there are a handful of other things. I mean, most of you, or many of you, will have heard, and if not, then you need to be aware of these: the TAM, the SAM, and the SOM. So the TAM is a total addressable market. How big is the space for the thing that the problem that you're solving? Okay, the bigger that is, obviously, the more likely the value associated with that is going to be big as well. The next thing then is the SAM, the serviceable addressable market. What is it of that big market for, or with the problem that you're looking at, that will be solved or addressed by your solution? The next one then, the final one then, is the SOM, the amount of that addressable market that you think that you can realistically achieve. So with those sorts of those three criteria, the TAM, the SAM, and the SOM, that can be on a local basis, on a national basis, on an international basis. But your understanding of those three is going to be critical to any investor being able to assess what the value and the opportunity set is for you. Then the next piece, once that's done, then the next piece is around have you got any real tangible validation or traction for the solution that you have? If you have traction and or validation of it that's tangible, then again, the investability and the value that people are willing to give you is high. Obviously, for businesses that are already running, you know, your growth rate is absolutely critical, as well as your let's say if you're talking about a subscription SaaS, you know, your month-on-month growth, your MMR, your ARR, these are going to be critical for any investor looking at you, and certainly your ability to grow that. I mean, typically, just as an aide memoir, if you can double or show that you can double your business each year, right now, as Xavier was saying, you know, this is a tough world at the moment, but if you can show that you can get 6% month-on-month growth for 6 months, for 12 months, that's doubling your business, right? And that people will invest in, even in this difficult, tough environment. I think much less than a 3% month-on-month growth will show a limitation in that traction, and that's where, you know, there'll be a lot more circumspect and diligence done on the business before you get a tangible value from the investor. But just in terms of numbers, I mean, typical SaaS investments at the moment, you know, if you're below that 5 or 6% month-on-month growth, you may be lucky to see 5 or 6 times ARR at the moment. Whereas, you know, 2-3 years ago, it was 10 plus. Now to get that 10 plus, you're probably looking at that 5 to 6%. If you're above that, then the opportunities for investment are much, much higher. If you're below the 3% month on month, that's going to be a tough gig to articulate. So you're going to need to have a very long runway. I think that's leave some space for other people to add on the valuation front.
Thanks, Ifty. Really, really insightful. I'm completely messed up with who's going in which order, so I'm going back to order you appear on my screen, I'm afraid. Xavier, could you provide a follow-up, or you know, have you got anything to expand on that?
Sure. The valuation question is always such a tricky one. I mean, especially the earlier the stage of the business is definitely more of an art than a science, because there aren't so many numbers to base it on. But you know, there are so many factors. The team, for instance, as well, will be key in there. My broking team usually works on seed stage stuff when there is some traction in the market, but pre-seed will look at if there's an absolutely exceptional team that you know has been there and done it before, so that can definitely add to the valuation. Kind of keeping more on the art as opposed to science side of it, we debate this a lot in the office, and one of our founders, Mike Liebus, put it quite well a few years back, is that those early stage valuations, a lot of people, you know, it gets inflated. I think maybe crowdfunding doesn't help in terms of inflating some of these in some of these valuations, but almost the value at that stage of your business is how much would you take to step away now? You know, that incorporates everything, all your hopes for the future and what you've done up until then. But, you know, realistically, if you've been working on it for a year and a half and you haven't really established it that well, but it's moving along, but somebody offers you $1.5 million for it, and you think, yeah, I would step away for $1.5 million, then it's probably worth $1.5 million. It's not necessarily worth 6 million at that stage, as some people kind of say, well, there's a huge market out there, but you haven't really penetrated that market properly yet. So you can't base your valuations on that. A lot of people base their valuations on projections, which I think investors tend to shy away from as well, because that's all they are, really, projections. And when you've got such a small a set of numbers to work off of in such a short period of time, it's difficult to give those valuations and base things on base valuations on those.
I really like that way of sort of summarizing it. You know, what would it take for you to walk away from this? It really sort of instills some reality
It
into.
sums up everything, right? It's
Yeah.
the reality of the situation, where the world is going, all these kind of things. Your hopes and dreams, you might turn that 1.5 million down and think, no way, this is really going somewhere, and it's worth 5 million. You know,
Yeah.
it's also about who the drive of the person behind it too. So that has to be factored in.
Dharma, you mentioned already, you know, you deal with the earlier stage businesses, right? Pre-seed. So from what I've heard so far, maybe more art than science, but it'd be really interesting to hear your views on this, and I guess your views from the VC side as well, because typically there's quite a forensic approach to this sort of thing.
Yeah, I guess the sort of, for anyone who hasn't done valuations before ever, it is worthwhile also just looking at some of the sort of standard reports that look back at sort of the valuation levels in the past quarter, in the past 2-3 quarters, even in the past year. So KPMG's European Venture Polls, for example, has a really comprehensive report on a more regular basis, or PitchBook data that also is freely available to everyone. You just have to download the reports, which sort of showcases what sort of, where you can get a bit of a sense of what sort of valuations are like across different stages of the funding landscape as well. So pre-seed, seed, although they largely say seed and angel, which is not helpful, as well as sort of growth stages. But I guess sort of the trend is that valuations seem to be fairly regular and normal, sort of pre-pandemic levels again, which is quite nice, because then it's a bit more realistic in terms of what sort of startup growth we can expect. The one thing I would say is that also would help sort of think about the future a lot more in terms of what sort of fundraising journey people will embark on, is to actually just consider what sort of trajectory people envision for their product as well, because the biggest jump in valuation is just your traction, right? And how much revenue you can generate at XYZ point. And sort of even sort of anticipating how much money you might be able to make from selling your services or selling your product is a helpful way to sort of structure then. Would it make sense to just maybe skip a seed round because you're revenue generating enough and you're relatively small team, bootstrapped, are very comfortable, maybe not taking a really high salary, but then go for a much, much higher valuation with a bigger equity stake when you raise your Series A round. And those are like real considerations that people are taking right now, because the fundraising landscape is quite tough. And the mid-stage capital gap to Series A exists and is getting bigger and bigger. So actually thinking about how you want to structure your financing round from the get-go, even if you're at the very early stage where you just have an idea, but also thinking about how often you need to do this circuit and go through the motions of raising money from different individuals, from different entities as well, is hopefully going to give you enough confidence that you can build those relationships early, because everything thrives on the relationship and the trust that you build with these individuals and those firms. So you can already try to sort of segment your way into how you want to run your future fundraise as well, which is a lot of work. But it definitely also helps with sort of thinking about what sort of valuation to hit in order to be attractive to those type of investors as well. That would be sort of what I would suggest to founders, that it's a very helpful exercise to actually think about your fundraising journey as a whole, not just your imminent round. And also then sort of compared with the valuation that you want to reach rather than the one that you can project.
Do you think those sort of sky high valuations we were seeing in 2021 were a bit of a aberration then, and you know, going forwards this is, this is the new normal. Is that?
Yeah, I mean, time is sometimes we still see these type of high valuations. I'm in a few sort of angel groups, for example, where sometimes a deal drops where you literally like, oh, this is a team with no product, but it's a serial entrepreneur who's now building a health tech business, and he, usually it's a he, because we live in this world, but hopefully can change that. But oftentimes it is sort of, yeah, they've exited their business twice before and now onto the third business. So this, even if it's pre-product and literally just on paper, they might get a valuation of like 35 million, and you're just like, that is insane. That could not fly unless you are like a Sequoia or a Tiger or yet another sort of US top tier VC. So we still see those type of rounds from time to time, but realistically, you would hope that people have a bit more of a measured approach as to what is going to be helpful to you in the future as well, because the likelihood of then reaching an even higher valuation with a lot less traction is going to be much, much harder for those founders as well. So also thinking about what you can achieve, what sort of milestones you can hit to unlock the next funding round is going to be critical. But yeah, hopefully we see sort of pre-pandemic levels when it comes to valuations, much more realistic. There's still art more than a science, but there are certain things that you can validate and can sort of showcase that this is a valuable contribution that just validates and actually evidences that the valuation is correct.
Brilliant. And we're almost out of time, but there's a question in my Q&A, which I am trying to monitor, which chimes with something you mentioned, Dharma, about timing and thinking through the journey. So one of the people here mentions that they have a business that is revenue generating, and that investment would help them scale quickly. But the question is really, when is the best time to actually go and look for investment? When should somebody maybe stop bootstrapping and start going out to market and asking, who wants to fund this? And yeah, I'll start with Dharma, but I'd be really grateful, Xavier and Ifti, if you could add your thoughts on that before we close off.
Yeah, I mean, we've got a really tangible example in our portfolio. We invested in a company called Dr. Doctor back in, I believe, 2012. We were the only investor up until 3 years ago, I believe, in that company, because they've sort of focused on becoming revenue generating. We're doing really, really well on that front. We're one of the first few sort of companies providing sort of appointment scheduling through the NHS, and we're the first ones to sell through NHS England as well, which is quite a big achievement. But when it sort of came to the point when there were more competitors actually entering the market as well, when there was a lot more competition for the same type of customers, that's when they sort of realized we actually need a lot more capital to sort of be very sales focused and just convert more customers on a bigger scale. And that's where sort of VC money and growth money was really handy, because that just enabled them to rapidly scale their sales functions and marketing intensity as well. So at that point, even though we were the only investor at that stage with a £15,000 investments back in the day, they went out to raise a Series A round, got another impact VC as sort of lead investor as well, who led their Series A, and it just enabled them to rapidly go and even reach a bigger audience and convert their customers much, much faster. So the crux of that sort of story is essentially to also just get a bit of a pulse check on who else is in the market and how marketing or sales intensive you need to be in order to unlock more revenue, essentially. And if VC money or angel investment or any type of capital, that could be venture debt or revenue-based financing even, can unlock that sort of rapid spur in growth as well. But then also thinking about how do you then retain those levels? Because that was sort of the philosophy of a lot of startups in the past 2 or 3 years, is that they rapidly grew, rapidly expanded their teams. And then a lot of emphasis was put on you need to be a bit more lean in your operations. So you might need to scale back your teams again in order to be revenue generating on a smaller basis, in order to keep going and burn less money. But yeah, that's sort of the conundrum that a lot of startups are faced with. But that's potentially one of the ways of actually thinking about unlocking capital as you grow.
I think Doctor are a brilliant example, Dharma. We love them. I think there's a couple of things in terms of when to go out. Obviously, the macro environment is key, and going out to get capital when you need it is really tough. So Dharma's example where people were throwing money at businesses and they were trying to scale irrespective of whether they had paying customers. It was just build the market, build up a team, and then all of a sudden the world changes, the money dries up, and all of a sudden, forget that old story about growth rates. It's all about economics now. It's about profitability, EBITDA, etc. So you need to be really careful about leaving yourself exposed as a founder, as a business, to whatever the environment may change. Now, sometimes you can't control that, but you do need to be aware of it. So going out when you need it, when you need money, that's going to be the toughest place and the toughest time, and the time that you'll probably end up being tight. The screws will be tight in terms of what comes across. But then the other piece is around being able to demonstrate, look, we've got a solid business plan, and actually there's an opportunity that we can take advantage of, which is going back to the doctor example. There's other people coming into this market, but we're ahead of the game. Come and join us and we can fly together. It's how you tell the story. More than anything, going back, and Xavier mentioned it earlier, that communication is not just about reporting, etc. It's selling the story. As founders, as businesses, that is what you are. We're all grown-up people. We all know that somebody who's already succeeded is more likely, probabilistically, to win again. So it's about selling the why you're not going to be one of that 10 a penny startups, 80 to 90% of which fail. Why and how you're going to be one of the 10 or 20% that's going to be there tomorrow and the day after, rewarding these people. And it's about getting in that story out continuously, but definitely ahead of when you need the money.
Final thoughts, Xavier?
I mean, yeah, it's been covered, I think, and also just make sure that you give yourself enough runway for these raises too. We get some people coming and investors can smell desperation. If you're too close to the bottom of the boat falling out, then they will punish you on the valuation if they do come in, or just step away thinking that this person has not thought about this long term, and that's not who I want to back. So yeah, give yourself plenty of leeway and then a little bit of fat on top of that, I would say, at the moment, because as Dharma said originally, there's more due diligence happening these days.
Brilliant. Thanks so much. We are about there with time. I don't know quite where the last hour has gone. It's gone quickly. I guess last thing from me, loads of questions in the Q&A section about how people can find the right investors, how they can reach out. As I said at the beginning, Xavier runs the brokerage division at Angel Investment Network. Really useful resource for founders trying to be connected to angels. They are an international network. Dharma at Bethnal Green Ventures, UK pre-seed. Please remember what she said earlier about being tailored with who reaches out and not just spray and pray. Spray and pray, rather. To both of you guys, how best can people reach out to your respective organizations if they do have opportunities that might be interesting for you?
I mean, UK is angelinvestmentnetwork.co.uk. You can also find me on LinkedIn. There shouldn't be too many Xavier Ballisters on there. So yeah, feel free to connect with me. And also you can connect with the platform guys directly via the platform.
Yeah, and it's very easy for us as well. bethnalgreenventures.com/apply to find out a bit more about what we invest in. And then also get in touch if you wanted to speak to someone in our team, whether it's anyone on the investment team, including myself, or even Paul, who's our managing partner and loves to talk to founders as well. So we're all very happy to talk to founders about their tech for good ideas. And then we'll have applications open for our next accelerator program from next week onwards as well. So it's possible to directly apply as well.
I thought you were about to just give Paul's home phone number there, real hospital path. Look, thank you so much to all of our panelists, Ifti, Xavier, Dharma. From our perspective, if you have more questions, I can see there are tons more questions. I had loads more questions on my sheet too. If you have questions about investment, UK specific, because Vested is a UK platform, feel free to get in touch with me personally. Like Xavier, there aren't that many Guy Kaufmans out there, so it should be easy to find. Any questions on, I don't know, SEIS, EIS, cap tables, pitch decks, whatever it might be, always happy to help. And yeah, once again, thank you to all of our panelists. I think it's been a really great discussion today.
Thank you, guys, and thank you, Guy, for leading it through. Cheers.